So hi guys, I'm going to introduce to you the partnership formation. So in partnership formation, there are three types. First is that two or more persons form a partnership for the first time. Second is that a sole proprietorship and an individual form a partnership. And lastly is that two or more sole proprietorship form a partnership. So I am going first to discuss the first scenario above, in which two or more individuals form a partnership for the first time. So both partners are all new in the business. So in the example for cash contributions only is that Lera De Luna and Ana Briones agreed to form a partnership by contributing 500,000 cash each. So the entries that is going to record in the partnership is that debit cash worth 1 million pesos and credit both partners, which is De Luna Capital worth 500,000 pesos and Briones Capital worth of 500,000 pesos. So this is the entries that can be recorded in the book of the partners. So second is the cash and non-cash assets contributions. So Lera De Luna and Ana Briones agreed to entries to record the contributions in the partnership is debit cash worth of 400,000, equipment 100,000 pesos, and credit Briones Capital 500,000 pesos. Debit equipment 200,000 pesos, furniture 200,000 pesos, and credit De Luna Capital 400,000 pesos. Lastly is the contributions in the form of cash, non-cash assets, and industry. Example scenario. Lera De Luna, Ana Briones, and Jumilin Dungon form a partnership. De Luna contributed 500,000 cash and Briones contributed 300,000 cash and equipment valued at 300,000 pesos. Dungon is an industrial partner to contribute her special skills and talents in the partnership. The entries to record the contributions of partners De Luna and Briones in the partnership is debit cash 500,000, credit De Luna Capital 500,000 pesos. So in Briones, so debit cash worth 300,000 pesos, debit equipment 300,000 pesos, and credit Briones Capital worth 600,000 pesos. The entry to
I will be discussing the entries when a sole proprietor forms a partnership with the other individual. To understand the process, let me give you a sample problem. Magbanwa, a sole proprietor, decided to form a partnership with his friend Clova, who agreed to invest 120,000 pesos worth of cash into the partnership. All assets will be invested and all liabilities will be assumed by the partnership. The book of Magbanwa revealed the following: cash 32,000, accounts receivable 50,000, notes receivable 20,000, inventory 49,500, equipment 100,000, accumulated depreciation 40,000, accounts payable 45,000, notes payable 20,000, and Magbanwa capital 146,500. There are also additional information, which are the adjustments. So the first adjustment is a 10% of accounts receivable estimated to be uncollectible. Second adjustment is the inventory is overstated by 10%. And the third one is equipment is depreciated by 30%. And lastly, 1,500 interest on notes payable has accrued.
So after those information stated earlier, we can now proceed to the step 1, which is the revaluation of assets and liabilities of the single proprietorship, because those are recorded by historic prices and we need to update them. But always remember that no nominal accounts should be used in this step. All adjustments requiring nominal accounts should be debited or credited directly to the capital accounts. So the first adjustment is 10% of accounts receivable estimated to be uncollectible. So in normal circumstances, the adjusting entry would require a debit of bad debts expense and a credit of allowance for bad debts. However, these are the nominal accounts. So it is stated earlier that nominal accounts should be closed directly to capital accounts. So I will replace it as Magbanwa Capital. And for the amount, accounts receivable, which is amounted to 50,000, multiplied by 10% is equal to 5,000. So 5,000 is the amount So the second adjustment is inventory is overstated by 10%. So since the problem states that it is overstated by 10%, it means that the current balance is a 110% of the actual balance, which is the amount of 49,500.
So to get the amount, simply divide the 49,500, which is the amount of inventory, by 1.1%, that is equal to 45,000, and multiply by 10% that is overstated and equal to 4,500.
So the adjusted journal entry would be Magbanwa Capital 4,500 and credit inventory 4,500. And the third adjustment is equipment is depreciated by 30%. And the adjusted journal entry would be debit accumulated depreciation with the amount of 10,000 and debit credit Magbanwa Capital 10,000, which is the amount of equipment 100% times 0.30 is equal to 30,000. But it is stated there that the amount of accumulated depreciation is 40,000. So 40,000 minus 30,000 is equal to 10,000. So the fourth adjustment is 1,500 interest on notes payable has accrued. And the adjusting journal entries would be Magbanwa Capital 1,500 and credit interest payable 1,500.
So after evaluation, the balances are cash 32,000, accounts receivable 50,000, and we have now an account for allowance for bad debts, which is amounted to 5,000, notes receivable 20,000, inventory decrease of 45,000, equipment 100,000, accumulated depreciation 30,000, accounts payable 45,000, notes payable 20,000, interest payable 1,500, and Magbanwa Capital 145,000.
So after revaluing all the assets and liabilities, we will now proceed to the second step, which is closing the books of the sole proprietorship. So the process of closing the books of sole proprietorship was already discussed in your previous course, Accounting 1. But to recall everything, you just need to credit accounts with normal debit balances, while those who have normal credit balances must be debited. So, this is an example of closing the books. As we look back, the balances after revaluation, these following accounts, the normal balances of this is credit. And these all assets, the normal balances is debit. But now we are in the closing. We are about to close the books already, so we will do reverse. So the normal credit balances must be debited. That's why allowance for bad debts worth 5,000, accumulated depreciation 30,000, accounts payable 45,000, notes payable 20,000, interest payable 1,500, Magbanwa capital 145,500 are all debited. And then all the normal balances of all the assets is debit, but it is to be credited when we are about to close the books. So that's why cash, credit, 32,000, accounts receivable, 50,000, notes receivable, 20,000, inventory, 45,000, and equipment, 100,000. Just a reminder, we have to take note of all the accounts with underline because we have to compare this when it comes to opening the partnership books. After closing the books, we will now proceed to the last step, which is the third step, and that is opening the books of the partnership. So, we simply debit all the assets that the sole proprietor will invest and liabilities that the partnership will assume. So, in this case, the entries of the investment of individual will be similar to those discussed in previous scenarios. So, we debit all the assets that are invested, which is debit cash 32,000, accounts receivable 50,000, notes receivable 20,000, inventory 45,000, and the equipment 100,000. And we credit all the liabilities will be assumed, and that includes the capital. So allowance for bad debts 5,000, accounts payable 45,000, notes payable 20,000, interest payable 1,500, and the Magbanwa capital 145,000. To record the new partner, we simply record debit cash amounted to 120,000 pesos and credit Global capital 120,000 pesos. Note that the equipment or any property, plant, and equipment for the matter is carried net of accumulated depreciation. In short, at its carrying value. So that's why accumulated depreciation is no longer found here because it is not carried over, meaning it is not recorded when opening the books. And however, the accounts receivable is recorded at its gross value for 50,000, meaning before deducting the allowance for bad debts, the allowance for bad debts is carried over, meaning it is recorded when opening the books of the partnership. Last but not the least, when converting two sole proprietorship into partnership, we simply have to go through steps 1 and 2 for each sole proprietorship. So that revaluation and closing the books are to be done, and we can proceed to step 3 in order to form the partnership where you can make the opening entries. So, I guess that's all. I hope you learned something from us today and you will remember everything that we have tackled. So this is the end of our discussion. Till next time.
I'm feeling sexy and free.